everyone, and thank you for watching my videos. As you know by now, risk management is a very important concept that we all must master in order to become successful Forex investors. So what I want to do right now is take some time to discuss with you how important it is to determine how big we should open our positions before we actually open them. So position sizing. It's a great way to practice managing our risk, and it's also a great way of exercising discipline. So here's what we need to know about position sizing. We need to know that setting the correct amount of units to buy or sell of currency pairs is very important in order to determine how long we last in this market. And also, it is the most important skill that every trader must understand, as it is a key to successful risk management. So again, we need to understand fully how to manage our risks, and it is a difference between life and death of your account. Now, here's what we need to know about position sizing. We need to determine how much we have in our account. Also, we have to take into consideration the currency pairs that we are trading, because some currencies carry more pip values than others. So we have to keep that in mind, and we have to be able to calculate pip values. This was something that we covered in my first video when we discussed what is Forex. So here we're going to reiterate the importance of determining the value of each pip. Now, we also need to consider the percentage of account you wish to risk. So just like I showed you before, the difference between risking 2% of your equity or risking 10% of your equity. So by now you should understand the difference. Also, we need to determine stop loss, because stop loss is also very important in order to determine risk management. So the size of the position does involve stop loss and conversion currency pair exchange rates. So we're going to talk more about that. So I just want to give you an idea as to how important it is to measure the size of your position before we open the position. That way we last longer in the market, and we don't have to worry about getting margin called, and we don't have to worry about large amounts of capital being wasted. Okay. So let's move on to calculating position size. So let's say you have $5,000 in your account, and you decided that you're only going to risk 1% on every investment. So what this means is you want to trade, if you decide to trade euro dollars, I'm just putting this here as an example. So if you wanted to trade the euro dollar pair, what we should do is we should put the stop loss at 200 pips. So I've already calculated this for you. So if you want to lose only 1%, well, of course you don't want to lose, but if you are able to manage losing 1% of your capital and you have 5,000 in your account, then 200 pips would be a good place to put the stop loss. So how did I come up with this figure? Well, I've taken 5,000 US dollars, multiply that by 1%, and it comes out to $50. So that means when I open a position on the euro dollar account, I don't want to lose more than $50. So that's how, so that was my plan. So my plan is, if this decision to enter the market is a bad decision, then let me lose no more than $50. So that's what I'm saying here. However, US dollars, 50 US dollars times 200 pips, that means each pip is only worth 25 cents. And since each pip is worth only 25 cents, and we're talking 100,000 units of the euro dollar pair, that means 2,500 units of the euro dollar pair is what I am willing to risk to make sure that I don't lose that 1%, or I don't lose more than 1%. So that's an example of how I was able to manage my risk just in case the market heads in the opposite direction of which I want to head it. I want it to be headed in. Okay, so account information in the base currency. So again, since the euro is the base currency, we should figure out exactly how much we're willing to risk in the currency of the base currency. So let's change the US dollars into euros. So 5,000 euros times 1%, that means I'm willing to risk losing 50 euros. Now, note that we have to convert this into US dollars because of the value of the currency pair is calculated by the counter currency. So, let's say the current exchange rate for 1 euro is $1.50. So, or 1.50. And then what we have to do is we invert that to get the exchange rate for the euro dollar, and then multiply that by the amount of euros that we're willing to risk. And here's what that looks like. So what we've done was we've taken $1.50 US money, divide that by 1 euro, and then we take that quotient, multiply that quotient by 50 euros, and that comes out to 75 US dollars. Now again, before I calculated in US dollars, but that was just to show you that when I have US dollars in my account, how much we're willing to risk. So I'm thinking at this point in the video, many people are confused as to why did I jump from 5,000 US dollars to 5,000 euros? Well, the $5,000, that was just how much we had in our account. The reason why I switched from $5,000 to 5,000 euros is because when we open a position, whether we go long or we go short, the value of that position is calculated in the base currency, in this case euros. So in case you're confused, that's why I showed you 5,000 US dollars and then I switched to 5,000 euros. Okay, so I hope everyone's caught up with me at this point. Okay, so again, 50 euros, that's how much we're willing to risk, because remember, we only want to lose, well, we don't want to lose, but we are committed to making sure that we lose no more than 1%, which is where the 50 euros comes in. 50 euros, and if the exchange rate is $1.50, that would mean 75 US dollars. Then we multiply that by 200 pips, meaning each pip move is worth 37.5 cents. So if we gain 1 pip, then we gain 37.5 cents. Or if we go back a pip, then we lose 37.5 cents. 37.5 cents per pip, and then we multiply that by 100,000 euros, 100,000 units of the euro dollar pair. Divide that by $1 per pip, and that gives us the equation of 3,750 units of the euro dollar pair. So many people are, I know I'm going a little bit fast, but what I'm really doing is I'm just getting to the point of showing you why it's important to determine how much we're willing to risk, and the way we do that is by determining the size of our position, so it makes it easier for us to manage our risk well. So that's why I put all these formulas and all these calculations on this PowerPoint, so to give you a better understanding as to how I came up with my calculations and how you can come up with your calculations. Okay, so here's an example of complex position sizing. So it just means that the account domination is not in the currency pair traded, but the same as the conversion pair's counter currency. So here's what I mean by that. So let's say we wanted to trade the euro pound pair. So how do we measure the value of the position that we open on the euro pound pair if we're trading in US dollars? And how do we calculate whether or not how much is 1% of that position worth? Okay? So let's see how we do that. So let's say the British pound US dollar pair is, let's say it's $1.75. So again, because if we have US dollars in our account and we're trading two currencies that do not include the US dollar, so we have to be able to determine the exchange rates of each currency compared to the US dollar. So that means the British pound US dollar pair, let's say it's $1.75. And remember, we have $5,000 in our account. That means we don't want to risk more than 50 US dollars. So 50 US dollars, multiply that by the quotient of 1 British pound divided by $1.75, and we have our answer, which is 28.57 pounds. So it just means that when we get into this market, we don't want to lose more than this many pounds. And then we need to figure out how much each pip is worth, which is 14 pounds. And we take that information, actually, excuse me, not 14 pounds, but 14 100ths of a pound, excuse me. So 14 100ths of a pound. I read the decimal wrong. And multiply that by 100,000 units of the euro pound pair. Divide that by 1 pound per pip, and we have an approximate value of 1,429 units. So that just means when we open up our position, we should sell no more than 1,429 units. Now, it's highly unlikely that your broker will be able to allow you to open up an account with that exact amount of units, so probably it would be safe to say that we're going to sell no more than 1,000 units. Okay, so account denomination, it's not in the currency pair traded, but it's the same as the conversion pairs based currency. So how do we do that? So let's say we're in Switzerland and we want to open a position in the franc-yen pair, risking 1% with a stop loss of 100 pips. And we have 5,000 francs in our account. So this time, we're dealing with an account that is not denominated in dollars, but denominated in Swiss francs. So how do we do that? 50 Swiss francs times the quotient of 85 Japanese yen divided by 1 Swiss franc equals 4,250 yen. And 50 francs equals 100 pips, for example. Which means 4,250 Japanese yen, we need to divide that by 100 pips, which means each pip is worth 42.5 Japanese yen. And we take that, multiply that by 100 units of the franc-yen pair, and also we take the 100 units of the franc-yen pair, divide that by 1 Japanese yen per pip, and that gives us 4,250 units, which means that if we wanted to trade in the franc-yen pair and we wanted to keep our risk under 1%, we should trade no more than 4,000 units. Okay, so let's move on. So I know this information may sound confusing. I threw out many different numbers at you, but if you watch this video again and take better notes next time, then we can understand that risk management is very vital, and in order to exercise good risk management, we need to know how big the sizes of our position should be. So, and also it helps to determine which percent we want to risk. So if you want to risk 2% or if you want to risk 10%, it's up to you, but take that into consideration how much of your balance you're willing to risk so you don't get margin called, and plug the numbers that best suit you into the formulas that I showed you in this video. So now that we know how to sell the correct position size, but see, the thing is, that's only a small fraction of what makes you a successful risk manager. You want to know what else you need to have? You need to have discipline. So again, we're talking about our trading strategies. We're talking about our trading plans. And we're talking about our trading styles. So we need to know how much of a commitment we're willing to make according to how much time we're willing to spend. Also, making that plan, sticking to that plan, and trading only according to that plan. And if there are flaws with our plan, then write down those flaws, improve on those flaws, so they won't be flaws anymore, and we won't be able to make those mistakes in the future. So remember, discipline is important. Okay, so we talked mainly in this video about how big our position should be, but really, we must have enough discipline to understand how big our positions will be when we get into this market and we examine what is happening in that currency pair as our positions are open. Thank you for watching this video, and good trading.